Hey, good morning, my friends. It's Hammer. Today is Thursday, December 12th, 2024. I, of course, am with Originator Success. Here is your daily mortgage rate update where you can join me live each and every weekday morning, 9:30 a.m. Eastern time, except for yesterday because I was on a plane and the latency is terrible. So I couldn't even pretend like I was going to do a live, even though they tell you can't stream live. I was able to start the meeting, but you never would have. The video would have been terrible. The audio would have been terrible. Wasn't even like I could come to you. So anyway, I'm here most of the time. I'm here today, and it's 9:30 a.m. Eastern time back in Western North Carolina. If you're watching on the replay, don't forget, give me hashtag replay in the comments. Would love to have you here live. It's fun to be here live. However, if you can't make it live, or because I do this at 9:30 on the East Coast and you don't want to get up that early on the West Coast, I don't blame you. So if you join me on the replay, go get and give me a hashtag replay. But whether you're here live or on the replay, don't forget to smash that like button. Maybe tag an LO friend if you're on Facebook. Share this post in a group. And if you're on YouTube, make sure you go ahead and subscribe, click the thumbs up, all that good stuff. So let's go ahead and say hi to the live folks here this morning, all of my friends. Got a question of the day for you today. Would you rather never age? Let's take these off. They just reflect. Would you rather never age or never have to worry about money? Would you rather never age? That's a long life. You look beautiful. Or never have to worry about money. My answer, I would rather never have to worry about money. I don't want to live forever. I wouldn't want to outlive everybody else. And honestly, I'm okay. I'll live a full life, but I'll be ready when it's my time. So that's for me. What about you? Give me your answers in the comments. In the meantime, let's say hi to all the live folks here this morning, all of my friends. James Mahan, good morning, sir, coming to me from the YouTubes. Mike Morano, welcome back. How was the trip? It was good. It was good to see friends. We had some fun. I'll tell you, we did not have a lot of LOs in the room. I know it's hard right now. I know people are struggling. I get it. But some of the best speakers and the workshop format, because it was a small crowd, was amazing. The quality of the content that I saw in this room was absolutely insane. It wasn't just a kumbaya feel good thing. There was implementable, actionable, go get loan type content. So it was really good. Thank you for asking, Mike. Laura McCain, good morning. James Mahan, love the reel you guys put on your social media yesterday. Oh, that's all Austin. So, hey, y'all, James Mahan is talking about Originator Success. Remember, check us out at originatorssuccess.com. Find out how we help you get loans from Google and social media. One of the things that we did is we put a really, really fun meme. Austin tracks all the trending stuff on social. We're going to raise our game in 2025, James. We got some really awesome stuff coming, so I'm proud of that. Ron Siegel, good morning, sir. Today is National Gingerbread House Day. Okay, hold that thought. Ron, tap dance for me. Everybody hold that thought for a minute. I'm gonna show you. Today is National Gingerbread House Day. Hold on. Oh, it'll take me too long. I'm slow. My wife made an awesome gingerbread house. It's sitting out on the counter. I was gonna go get it and show you guys. Ron, I wish I knew. I would have had a picture. Michael Love, good morning, sir. Brandy Brickler, good morning. Hey, let me know in the comments too. Do y'all do gingerbread houses, or do you, with your kids, or do your kids do gingerbread houses? We've always done that and that kind of a thing. So, good morning, Michael Love, Brandy Brickler. Good morning, Monica Dinkins. Ron said up early on the West Coast. You're Ron. I don't think it's for me. I think you'd be up early no matter what, my friend. I think you're just that kind of guy. Brandy, very glad to read your good news, by the way. Hugs your way, my friend. Hugs. Can you see it? Hugs your way. Very glad to hear the good news on that. So, Deb Dickinson, good morning, my Schmogan Tom Deadmore. I'll go over your answers on the question of the day. I'll roll back and we'll do that. I got to get to the good stuff in a minute, but question of the day: would you rather never age or never have to worry about money? We'll come back. We'll talk about that. Let's go ahead and hit the other stuff. If I didn't say good morning to you, my apologies, my friends. So anyway, let's do a quick recap of what happened yesterday. Actually, you know what? I got to look behind it's going to chase me here. Hold on. I can't, you know what I have to do? I have to move this window. There we go. All right. I'm going to move to here. And let's go ahead and share the screen. usually have this prep, but here you go. All right. So quick recap, what happened yesterday and where are we at? Let me zoom in on this and see. All right. So you can take a look here. I'll put this on the 2-day chart for a minute and you can see. So yesterday, see this tick up right here at the peak. So this is where mortgage-backed securities were yesterday as pricing was coming out. We had seen an actual positive into the CPI data. Now, the CPI inflation data, it came in as expected. It wasn't anything special. Oh, I don't like that one. It really wasn't anything special. However, we did see a positive reaction to the CPI inflation data. Mainly because it was what I will call a mini relief rally. That's what happens when you have expectations that maybe if we had seen inflation coming in higher, that would have blown up the chances of a Fed rate cut coming in December. And instead, when everything came in as expected, remember the Fed uses the PCE, not the CPI, but when that data came in as expected, it kind of was a bit of a relief rally. So we saw that improve on the day. However, it started to lose ground. We put out a reprice risk alert over here as we took that second leg worse. So if you don't get our text alerts, make sure that you do sign up for those. www.ratelockalerts.com, or I'm sorry, ratetextalerts.com. Check it out. Use this QR code. So we sent out a text alert. I was going to show you my phone, but my phone's my camera. We sent out an alert in the early afternoon, right about here, that we were at risk of seeing reprices worse. And we did. We saw quite a few reprices worse. The relief rally slipped away and many lenders did reprice worse, as it says on the screen. So today, we're also continuing lower. You can see we've gone another leg down. Mortgage-backed securities are down a couple of basis points on the day, 101.21. Yesterday, when pricing was coming out around 10 a.m., even though it wasn't at the peak, it was still around 101.40, 45. That's about 25 basis points higher than what we have today. So rate sheets today are going to be worse. Now, prices aren't too far off, but they are slipping. So if you take a look here, the 6.80 that they got on Mortgage News Daily for yesterday kind of reflects an end of day after the reprices because it's worse than the day before. We were like 6.72, then 6.78 on Tuesday. Wednesday, we went back to that 6.72-ish mark. However, after reprices worse, that's what it reflects a little bit worse on the day. So going from 6.72, where rate sheets were in the morning yesterday, to where we're at today, we're probably about 6.82. So you're seeing rates that are going to tick up. Now, we're not too far off the worst levels. I mean, we improved a little bit before we're back to where we were at the beginning of December a week ago. But still, we're seeing it pull back, and I'm going to go more about that. As far as today goes, reprice risk on the day is moderate. We're already down a bit, and we could see things get worse. The data that came out this morning, the wholesale inflation data came out as expected. I'm not going to go pouring over the numbers. Wholesale inflation doesn't have a huge effect on the market, but it does have some. Jobless claims came in around 242 instead of the expected 225. That's a little bit of a reason why you'll see a little bit of improvement in bonds this morning at 8:30 when you get that. But that helped to bring the a little bit of improvement, but not enough to get overly excited about by any means. But look at these trends. Let's look at the pattern, right? Again, the lock advice at the bottom, bonds are slipping. Real quick, let's do the Fed watch, and then we'll go over some of the technicals. So as far as the Fed watch goes, let me bring this up to you. So we are at this point now up to a almost 100% expectation that the Fed is going to cut rates in December. Now, the inflation data came in as expected, but showing inflation, right? It's year over year, month over month. It's still showing inflation. The 6-month average has gone down a little bit, but it's not like inflation has gone away or that it's even below where the Fed wants. Now, it's funny because I see news articles talk about the CPI not being at 2%, which is the Fed's target, but the Fed isn't targeting the CPI to be at 2%. They're targeting PCE to be at 2%. PCE will come later in the month. It's personal consumption expenditures. CPI is what we got yesterday. That's consumer price index. CPI puts a lot more emphasis on shelter costs and a few other things. Shelter costs were, still came in high. One of the reasons why things are why we're seeing inflation. It's expensive to live. So right now, though, markets believe we're going to see a rate cut at the end of the month. And I do too. I think we will. I think it'll complete the cycle. We will have gone down a full point. Remember, we did a half point at September Fed meeting, quarter point at the November meeting. I think we'll see a quarter point in December. Now, the Fed expectation in January, the expectations are that the Fed is going to pause. There's a little bit of a percentage. I knew you'd put that on there, Siegel. There is a little bit of a percentage, a quarter percent out there that believe the Fed will keep going. I think this is just some hedging and betting, and I don't think it's going to happen. Am I the only one? I think the Fed is going to cut. And Ron, write this down, and I want to know, Siegel, what you think. The Fed is going to cut in December, and I think they're going to pause. And I don't know if we're going to get any cuts in 2025. I think this may be the neutral rate. I think getting down to 4.25, maybe one more cut to 4. But I think that's the neutral Fed funds rate right now. Markets are believing that by March that we're going to have another cut, right? There's about a third that say no, but there's 2/3 that say that we will. When you get later into the year, May, still at about 4%, but they're getting into the 3s here. You look at June and it gets deeper into the 3s. Very few people, markets are not pricing in the idea that we're going to be at the same Fed funds rate by the middle of June. And I think that the Fed has plenty of runway to go ahead and cut rates to improve markets if they have to. I don't think that they're choking out markets. I think what'll choke out the economy is when the credit bubble bursts, when people can't spend money that they don't have. But I don't think that this is going to be a thing. And this is important. The reason we're bringing this up is that for years now, the last few years since the pandemic, mortgage rates have very much taken their cue from the Fed funds rate. If the Fed is no longer adjusting rates, we're still going to see a lot of focus on that. But what else are bonds going to go? I mean, man, it's been about 8 years. There was a time that bonds would move up and down every time oil prices moved up and down. That was the main driver. We're going to see a lot of things happening when Trump gets into office and his administration takes over with the stock markets, with the economy. And we have to see what is it that investors and traders are following and what are bonds tracking in all of this, right? So we're going to have to see where all of that goes as far as things go. But I think very much we are very, very much in a situation where the rates that we're looking at now are the rates that we're going to have as we get into the end of the year. I think high 6s, low 7s for your conventional conforming stuff is going to be your normal rate. Govy stuff, of course, being about a 0.5 point better than that on average. But overall, I don't think there's much improvement for rates to improve from here. I mean, there's much room for rates to improve from here. I don't think there's much improvement on the horizon. I think these are the rates we're going to see. We have to get used to. People are going to be giving you that answer of, well, I want to wait until rates drop. And this is why, and I said this at the event I was at the other day, I saw some pretty sanctimonious posts on Facebook where loan officers were saying back in September, and I'm going to go over some technicals in a minute, but they were saying back in September, oh, don't refinance now. I'm not telling my people to refinance. We're going to wait until rates come down further and they get the full bang for their buck, and I'm not going to churn those loans. They weren't saying that out there, but they were pretty damn sanctimonious standing on their soapbox. And if that was you, I want you to take this as a loving wake-up call, okay? We never know what's going to happen. I'm the guy who thinks he knows what's going to happen, and yet it still goes south, right? And we'll talk about the technicals, and I'll show you in September. Actually, let's bring that up, and we'll go through that piece now, right? So here in September, mortgage-backed securities, I'm going to go full screen so you guys can see this clear, right? Let me just pull this up and hold on. All right. So taking a look here, right? This was September. September was the peak. And when I say it was a peak, let's go back for a year looking at mortgage-backed securities for a year. All right. Now we are looking, let me make it a little smaller so we can see all of that. Hold on a minute. There you go. Okay. So as we take a look here, we are looking all the way down here, right? We have all the way down, all the way here. This is where we were a year ago. Let's go 5 years. Take a look at this. Okay. So looking at 5 years ago, this was all COVID, right? So during COVID, mortgage-backed securities, I mean, look at this. They were selling like crazy high levels, right? And again, the 6.0 coupon was so far removed from reality. We were in a 2 and a 2.5 coupon. Look at how this coupon was trading. Then we get into, okay, we get into 22, and it all falls apart. And we all know that 22 was a tough year. 23 was a worse year. 24 was so 22, they start to come down and sell less. All right. And then 23, look at where we're at. Now, we have not been back at these levels, 102.50, 102.39. And these are weekly candlesticks at this point. In September, we were at 102.34. Right? That was the 102.38, 102.34, the 102.30s were our best levels that mortgage bonds, the 6.0 coupon, was up at in September. We had not been at that level since back in 2023, January of 2023. Okay. And look at the path. They went down, and we saw the worst rates that we got. This is back here in October, right, of 23. Remember, that was when rates were in the 8s in October of 23. This is when the Fed kept raising and raising and raising and raising. Then we saw a huge rebound when the expectation was that the Fed was not only done raising, but would start cutting. And if you remember, December of last year, a year ago this time, we were like riding the wave thinking, hey, things are going to be better. I'm going to put myself on the screen for a minute. So a year ago, December of 23, it looked like, hey, we are really riding the wave. Things are going to get better. And it was right here. You see this, this increase in all these green candlesticks. We were just improving. That's it. 2023 is going to be a great year. I'm sorry, 2024 is going to be a great year. Here we go. We're improving. It's awesome. And then we got smacked with the reality of inflation started going up again. Remember, that's what happened at the beginning of 24. The inflation number started to come up higher again and saw things happening there. Now, as that dropped, right, inflation came in higher, bonds started to lose ground, and we peaked right here at December, and then we started to lose ground. Now, the middle of the year, we were all the way down in April to the worst levels, and then we saw pretty consistent rebounding all the way up, peaking in September. Now I'm going to bring this to a year so we can get a little bit of a better idea. So looking at this for a year, and let me put this back on the full screen so you guys can see this with me. Okay. So looking at the full year, this is 2023, right? January, February, we lost ground. We recovered a little bit. April, we really tanked. This is when, oh no, the Fed is not going to cut. Then it was like, oh, okay, wait, the Fed is going to cut. We think Fed cuts are going to start coming. Okay, here they come. And we saw all this improvement heading up to September. The Fed starts cutting in September. We peaked. Now, I was saying that I expected us to improve from there. I thought that this would keep going. Instead, September 15th, after that Fed meeting, we lost ground in October, and we said, okay, don't worry, October is historically a bad month. And what did we say was going to happen? Y'all remembered? Y'all remember what we said was going to happen? Historically, October is a bad month. What happens in November? Oh, we usually get some recovery. We were expecting recovery. Did we get recovery? No, we didn't. Here we are. As we lose ground in October, November, it looked like, okay, hey, we're starting to get some recovery. And then boom, fell back down, worst levels, all the way down to the end, bottom here in November. Here we are a month ago, absolute terrible. Since then, we started to crawl out of it. We bounced back, and we're back to where we were basically when we were like, hey, we think that this is the end, back in October. Now, we have seen some look at these levels, right? We have seen mortgage-backed securities, they tested. And I have to refresh the page because it's not loading the candlesticks properly. There we go. We have tested this level. Look at this 100-day moving average. And we tested it last Friday. Then we tested it Monday. Then we tested it Wednesday. And yesterday we were up at this level. And I said, hey, this is very concerning. We're testing the technical support. I don't think we're going to break it. We were in a lock stance yesterday. Not that we were cautiously floating to start, but looking to lock. And that proved correct because yesterday we lost ground. And that's what I've said is We are not bouncing through this. Now, in order to see traders want to sell into this and for bonds to improve, we would have to be in a position where there's something happening to drive that. There is nothing happening. The Fed meeting next week is not going to be dovish. It would have to be dovish to help us. It's going to be hawkish. The Fed, guys, I was in an airport, these last couple of days traveling. The airport was slammed. The lounges were slammed. We went to a restaurant. Michael McAllister did not make reservations. Are you still on, McAllister? We went to a restaurant. Michael McAllister said, it's a Tuesday night. Who needs reservations on a Tuesday night? We went to the restaurant. It was slammed. Now, I'm not saying this only to pick on Michael McAllister, even though I do love picking on Michael McAllister. I'm saying it to point out people are out spending money. Yes, everyone says they feel it. It hurts. They don't have it. Somebody is spending it. Either a lot more people out there have money than we think, or a lot more people are spending it that don't. Either way, that is driving the economy. Because of all the economic, machine, the engine that's driving this thing, we're not going to see mortgage rates go down. It's just where we're at. It sucks, but it's where we're at. So, all right, let's go ahead and hit the comments one more time. I'm going to ask you the question of the day. Would you rather never age, or would you never have to worry about money? Let me know in the comments, and let's go through. I'm going to go through the chat and see what you guys have been saying to me, my friends, and we'll talk about that. So we'll go back to the gingerbread houses because I do love chatting with you about that. Let's see what Ron had to say, though. Ron said there's no legit inflation. The smart investors realize inflation is gone. 2/3 of the inflation is from shelter. CPI weights shelter at 46%. Only 8% of the population is changing their shelter, so it really has no real effect. PCE weighs shelter at under 20% of the calculation. Smart investors realize inflation is gone. Oh, yeah, that was the same thing. So I get what you're saying, Ron. That's why we got a bit of the relief rally on that for sure. Ron says rate cuts will continue, driven by the beige book. Okay, that's a really good. So for those of you that aren't familiar with what Ron's talking about, the beige book is the Fed releases once a month, and it's their release of data of what they're seeing in the economy in their different sectors. So remember, you've got like the Minneapolis Fed, the New York Fed, the San Francisco Fed, the Dallas Fed. You've got all these different sections of the Fed, and they release their data on the economy and their market. And so that's why, Ron, you see that. I would not be surprised. I don't know that we're going to see more cuts. McAllister says no cuts would be brutal. If rates start to hold, we should see 10-year versus 30-year spread normalize. Yeah, so Ron's brought this up before in the past. When we look at the idea of what the 10-year Treasury yield is at, what mortgage-backed securities are, where investors are putting their money, we're talking about what that spread is, the difference in there. Historically, 1.79, today 2.57. I don't know that spread is going to go back as much as it did, Ron. I really don't. I think this may be more normal. If servicers start to see they can make money in servicing and not forecast the refi, the spread will normalize. I kind of see that, but servicers have been living, by the way, the last couple of years with originations being down. A lot of servicers, a lot of lenders that service that's been bringing in the money in their portfolio. Servicing money right now is huge. Allison, never have to worry about. All right, so that's enough about that stuff. It's 24 minutes in. Let's go ahead and answer the question of the day. Let's go over your questions. So would you rather never age or never have to worry about money? Allison would say never have to worry about money. You can fix aging, do all the things to help your family with money. Absolutely. For me, I'd never have to worry about money. I want to age. I'm okay with aging. Nathan, I also asked about the gingerbread stuff. Gingerbread season, you believe in natural ingredients. Keep your head on a swivel. That's right. He's picking on the gingers. I saw your post, my friend. Gingerbread house made out of real gingers. I got you. Brandy, you guys make homemade gingerbread houses? That's hardcore. And Monica also loves making gingerbread houses with the kids. And hello, Alan Christian. Good to see you, sir. Megan Lindbergh said she would rather never have to worry about money than aging. I'm with you. Definitely my thing. Mahan said if you never age, you wouldn't learn how to better manage your money or your with time. Yeah, that's true. But if you never have to worry about money, you wouldn't have to worry about that either. I think all of us are on that same page. Kenny Rivard says never have to worry about money. Ron's hitting on the other one. Scott Pacent understands we need to reduce interest rates since the government spending is so much on interest. Yeah, that's true. All right, so now you're talking next level meta, though, right? Where right now what we pay to service our debt is tremendous. If remember our own government benefits from lower interest rates because they're paying lower interest rates on servicing all of our debt, and we're almost constantly refinancing our debt. So that is a big thing. So you're right. Scott Pacent understands we need to reduce interest rates. His 3-3-3 plan will bring interest rates down. Yeah, I do agree about replacing Yellen too. People spend what they don't have during the holidays when they've been hurting during the year. Spend to offset the guilt from the year. That's true. That's true. That's all possible. So, all right, my friends, I'm going to go ahead and wrap it up. Thank you for joining me. Appreciate all of you. Hopefully you got some value out of today's content. Make up for yesterday being on the plane. And I will see y'all. Hey, Jessica Wells, I will see y'all tomorrow. Make it a great one. Bye-bye.